Okay, we'll go ahead and get started. Good afternoon, everyone. My name is Ara Oghoorian. I am with ACAP Advisors and Accountants. And today's presentation is about the $1.5 trillion tax law that went into effect December of 2017. And as we get close to the end of 2018, this is very relevant because it is going to be applied for your 2018 personal taxes. Just a reminder that this webinar is being recorded and it will be available both on our website, and also if you have any questions, please post them into the chat box and we'll go ahead and add them to the queue, and then I'll get to all the questions at the end of the presentation. So please go ahead and ask your questions. Again, I will get to all the questions at the end. I do want to point out that this webinar is strictly on the individual side and how the new tax law affects individuals. There's a very brief slide on the corporate taxation, not so much corporate, but individual, how it affects individuals and corporations. But there will be a separate webinar that focuses entirely on the business tax changes that have occurred. So just to reiterate, this is only about the individual. Again, my name is Ara Oghoorian. I'm with ACAP Advisors and Accountants. I'm both a certified financial planner and I'm also a CPA. We are a private wealth management firm and a CPA firm. Our focus is primarily on the healthcare sector. That's well over 95% of our clients are in healthcare. As I mentioned earlier, H.R. 1, which is also known as the Tax Cuts and Jobs Act, was signed into law on December 21st, 2017. Most of the provisions go into effect in 2018. There are some that go into effect in 2019, which I'll describe later as well. But all the things we're going to talk about today, majority of them will apply for 2018 tax year. Quick roadmap, we're going to mostly talk about personal taxes, and at the end we're going to talk just very briefly about corporate taxes and pass-through entities and how the new tax law changes affect the corporate taxes, including what are known as sole proprietorships. The biggest change that occurred with the new tax law is that the individual mandate for the Affordable Care Act, also known as Obamacare, that has been repealed. So in the past, because of the Affordable Care Act, when people were assessed a fee for not having health insurance, that fee is no longer going to apply, but that does not go into effect until 2019. And it becomes permanent. So in 2018, if you still don't have health care, you will be assessed a fee on your tax return, but not beginning 2019 going forward. The other big difference is the tax bracket. So we'll look at both single and married filing jointly. We're not going to look at married filing separately because it's a rare instance where people file married filing separately, but the tax brackets are a little bit different as well. You'll notice that the tax bracket numbers are still the same. So there's still 7 tax brackets, but the biggest change is that the tax brackets are now lowered and they're widened. So instead of having a 15% bracket, now you have a 12%. Instead of a 25%, you have a 22%, and then so on. And then you'll notice on the top tax bracket, 39.6, that gets declined to 37%. And it's for a higher amount of income, but it's more pronounced, we'll see in the married filing jointly, where on the top tax bracket, you'll have to earn a significant amount more to be the top tax bracket, plus the top tax bracket is even lower. So whereas in the past, prior to 2018, someone who was earning $400,000 was in the 35% tax bracket. Now that's still the case, but they can earn up to $600,000 plus and still be in a 35% tax bracket. So it's a big tax benefit for majority of individuals. Like I said, the brackets have widened for both married filing jointly and also single as well. One of the other changes that has occurred is a personal exemption. So prior to 2018, everyone received what was called a personal exemption. So if you filed single, you got $44,050 exemption against your taxes. If you were married, you got another $4,050. And then for every dependent, it was the same situation. In 2018 and going forward, the personal exemption no longer applies. However, the standard deduction has nearly doubled. So if you're single and you don't itemize, the standard deduction jumped from $6,350 to $12,000. So even though you're not getting that personal exemption, the standard deduction for you has increased. If you're doing married filing jointly, also same thing, it also doubled, almost doubled. Whereas someone who maybe does not have a home or their home is paid off, in the past, they were not able to take that much in deductions for standard deduction. Now it's going to be significantly more, especially for people who are retired that may have low property taxes or no interest deductions. In the past, their standard deduction was very low, but 2018 going forward, it's going to be higher. The biggest change that's occurred and affects mostly states that are either on the East Coast or the West Coast that have high property taxes is what's called the SALT deduction, state and local income tax deduction. So prior to 2018, on your Schedule A, which was your itemized deduction, taxpayers were allowed to deduct their state and local income taxes. And it was limited to some extent if you're a high income earner. So if you're a high income earner, even though you took that deduction, it was limited on how much of it you can take if your income was above certain thresholds. Starting in 2018, state and local property taxes are going to be capped at $10,000. So there are some instances where people have $50,000, $60,000 of state and local income taxes. Now, starting in 2018, they're only going to be limited to $10,000. Keep in mind that the Schedule A, which is the itemized deduction, it only covers, it has several sections of it. One of them is the state and local taxes, but the other sections, which are casualty losses, miscellaneous deductions, and also charitable donations, those sections still remain, but with some changes, which we'll talk about. The next big difference is home mortgage interest, which also goes on your Schedule A. So prior to 2018, the interest deduction was deductible on $1 million of indebtedness and above. So if you had a property that you had $1.1 million loan on, you can only take a deduction on $1 million of interest. In 2018, if you purchased a home after December 15, 2017, then you're only allowed an interest deduction of $750,000 or more. I want to clarify that even though you refinance your home after that time, you're still, let's assume that you bought your home in 2016, way before that December 15, 2017 deadline, and now you refinance in 2018. You're still grandfathered in the old rule, which was the $1 million indebtedness. It's only if you purchase the property after December 15th that you're subject to the new $750,000 loan rule. So that is also another big difference. In the past, interest was deductible on up to $100,000 of indebtedness on home equity line of credit. So what what some people would do was they would take a home equity line of credit, maybe pay off some credit cards or buy a car, and that interest was deductible on their taxes. Going forward, that interest is only deductible if the loan is used to improve your home. Let's say if you got the loan, home equity line of credit to do a new addition or put a new roof on, or anything that is used to improve your home, at that point, you are able to deduct that home equity line of credit interest. Again, if you have questions, please go ahead and post them into the question box, and we'll get to all of them at the end. The next biggest change is the alternative minimum tax, also known as the AMT. The AMT historically was used to make sure that people who are high income earners pay their fair share of taxes. And the way that it happened was it disallowed a lot of what were Schedule A deductions, such as property taxes, interest on home mortgages. So what would happen is if someone was taking a large amount of interest or property taxes against their income, the AMT would disallow that, or it would discount that. So the AMT came down many, many years ago, but it was never indexed for inflation. So what was happening was it was hitting a lot of middle income people, even though their incomes were not as high, they were hit with the AMT tax. The new tax law significantly changed that by raising the AMT exemption. As you can see, from single, it went from $54,300 to $70,300, and then for married filing jointly from $84,500 to $109,400. That's going to have a big impact on individuals because now you'd have to earn a lot more for the AMT to actually kick in and to have it apply to you. The other biggest change is in the college savings plans. Prior to 2017, prior to the tax law change, 529 plans could only be used for college. But with the new tax law, 529 plans can be used to fund K through 12 education for up to $10,000 a year. So if you're sending your kid to a charter school, a private school, any kind of school that prior to college, you can use up to $10,000 a year against your 529 plan. Personally, I like to tell people to use keep their 529 plans until they have their children have reached college age, because college costs are escalating at a significantly higher rate than inflation. So if you're using them to fund K through 12, the money's not going to be enough probably to fund college as well. Some other changes that have occurred are alimony payments. So in the past, what would happen is if someone was paying alimony, they were able to deduct it on their taxes. And whoever was receiving alimony, it was taxable income to them. That is no longer the case. This is also another situation that does not kick in until December 31st of 2018. Alimony payments are no longer deductible by the payer, but they're also not taxable to the recipient who's getting alimony payments. So this is a big difference for someone who's either living on alimony or is paying alimony. In the past, if someone was moving at least 50 miles away to start a new job, they were able to deduct some of those moving expenses. That is no longer the case unless they're moving for military purposes. So unless it's for military, those moving expenses are no longer deductible. Another change is casualty losses. So casualty losses that exceeded 10% of adjustable gross income, also known as AGI, were deductible prior to 2018. That is no longer going to be deductible unless it's declared a casualty or a disaster by the President of the United States. The other change was Roth recharacterizations, not Roth conversions, and I'll define what that difference is. So prior to 2018, taxpayers who did a Roth conversion were allowed to do what was called a recharacterization, basically a redo. That is no longer allowed in 2018. A Roth conversion is when someone takes a regular IRA and they convert it to a Roth IRA. And when they do that conversion, they pay tax on that converted amount because that money's never been taxed before. With the recharacterization, it allowed people to go back to the regular IRA once they did a conversion, because if they paid tax on a higher rate and now they wanted to redo that, they could do that recharacterization. Unfortunately, that has been disallowed. Let's talk a little bit about the business entity types and what is known as, back up a little bit, what is known as the new qualified business income deduction. So there are many types of business entities. There's a sole proprietorship, an S corporation, a partnership or an LLC, or a C corp. As we'll see, pass-through entities are companies that are sole proprietorships, S corps, or partnerships. And a sole proprietor is basically someone who has maybe a side job. They're selling things on the side. They get paid as 1099. They don't set up a separate entity. All that income expense is reported through their 1040, their main tax filing schedule. If they are a S corporation, then what they do is they set up a separate entity. It's usually for small businesses. This could be a law firm, an accounting firm. These S corporations are a separate entity. They have their own profit and loss, their income and their expenses, and they file a separate tax return. And any net profit from that corporation passes through to the individual tax return on what is known as a 1040. The other pass-through entity is a partnership. This is pretty common among people who buy into real estate. So if they're buying an apartment building or any other type of commercial real estate, they will enter into a partnership such as an LLC. The income and expenses from that LLC are reported separately on what's called a Form 1065, and then that flows through to the individual tax return. The last type of entity, which is not a pass-through, is a C Corp. An example would be like a Google or an Apple. The reason why we bring this up is because the new tax law has a very favorable deduction for pass-through entities. So if someone is a sole proprietor, an S Corp, or a partnership, and they meet certain criteria, they are able to deduct 20% of the income that's passed through from that entity on their personal tax return. 20% is a huge amount for someone to deduct, and it's a big tax benefit for small businesses, especially for ones that meet the criteria and the thresholds that I'm going to describe in a moment. So as I mentioned, it's a 20% deduction on that qualified business income, and the qualified business income is one that comes from a pass-through entity, such as an S Corp, an LLC, or a sole proprietor. It does not apply to professional service corporations, such as doctors, lawyers, CPAs, anyone who uses their professional skills in their business. However, if those individuals, if those professional corps, if their income is below $315,000, if they're married filing jointly, or $157,500 for single, then they are still allowed to take that deduction. So again, a big benefit for small business or small companies. If the professional corp's taxable income is greater than that threshold, then unfortunately they cannot take that deduction. But if the corporation or the entity is a non-professional, let's say it's a mechanic shop or it is someone who sells cupcakes, then they are able to take that deduction. But there's a complicated calculation that comes into play for them to determine how much of that 20% they can actually take. So this was a really quick overview of the new tax law changes and how it affects individuals, and then a really quick brush over on how it affects businesses. So now we're going to open it up to questions for everyone. And please feel free to post your questions and we'll go ahead and answer those. Give me 1 second. Okay, let's go to the Q&A. The question is, can I deduct my software or laptop if I use it for work at home? If you are a W-2 employee, you are not allowed to deduct that that laptop or that software. However, if you are a 1099 contractor, you are able to deduct that. In fact, you're able to take what's called a depreciation against that computer that you've purchased. Let's see what else. So the question is, does the HELOC apply to the 80-20-20 loans that were used to purchase a house? And yes, it does apply to it. However, the same principle, give me one. the same principle applies. So if the HELOC is used to purchase a house, then absolutely it is still deductible, as long as it does not exceed the $750,000. And if the home was purchased before December 15, 2017, that could go up to $1.1 million. Actually, it's $1 million that it could go up to. The question is, can we send the presentation slides? Yes, those presentation slides will be available, and we will send those out. They'll also be, like I said, this presentation is being recorded, so it will be available on our website as well as all of our other social media platforms. Let's see if there's any other questions. The question is, can I use my 401k money to invest in stocks, and do I need to pay tax on the capital gains? So this is actually a two-part question. You can use your 401k to invest in stocks if your 401k provider has what's called a brokerage window. And a brokerage window is the ability to bypass the investment options that are available through your 401k and invest separately with a brokerage house that's designated by the 401k provider. This is not, and to answer the second part of your question, if you have capital gains in that 401k or that brokerage window, there are no capital gains taxes applied to it. But there's a reason why the brokerage windows are not very readily available and not recommended by employers, mainly because when you buy individual stocks, they tend to have a lot more risk than having mutual funds. The reason why the employer and the advisor have selected a certain host of investments within the 401k plan is not to make it a disadvantage to the employees. It's to provide a well-diversified menu of options to choose from. Whereas if someone were to go through a brokerage window and they bought, for example, Facebook or some stock that, nothing against Facebook, but some stock that declined in value sharply, then it could severely have a detrimental effect on one's retirement. So that's the idea. That's a rationale for companies not offering brokerage windows unless they know that many of the participants fully understand the risks involved with a brokerage window. I think those are the only questions we have. If there are no other questions, I'll go ahead and conclude the webinar. Thank you very much for participating. If you have any further questions, you can feel free to email me. My contact information is at the end of the slide. Feel free to email me and I'm happy to answer them. Like I said, this webinar is being recorded and we'll go ahead and have it on our website and all of our social media platforms. Thank you very much.